Hello and welcome. Today we're going to be talking about the financializations of savings theme, and within that theme we will speak with Prudent Corporate, who is a key beneficiary of that theme, not linked to the AMCs in terms of AUM accretion, but more linked to the retail participants in the industry. And those SIP numbers continue to remain resilient despite the 2 years sideways move in the market. And when you're looking at the stock price in the last 6 months, you've seen a decent 6.5 kind of % bump up in the stock price. And even Q1, for example, in terms of the numbers, have been very resilient. We'll talk about that and more. Let me first start off with what the company does. And to start that off, what it essentially does is it distributes mutual funds, insurance, and other financial products. It basically runs a platform which helps, and technology stack which helps people do that. It was founded in 2000, incorporated in 2003. Headquarters is in Ahmedabad, Gujarat. Of course, the story itself, what it essentially does is it onboards mutual fund distributors. So it has a connection or a client base of around 38,225 local mutual fund distributors, and it also has a relationship with AMCs. And what it essentially does is it helps the mutual fund distributor with his compliance work alongside a tie-up with the AMC to ensure that there is a seamless integration between the two. That's what it essentially does. So more money invested via partners, which is the mutual fund distributors, means a higher AUM, which means higher fees for Prudent. It currently has an AUM of around 1.4 lakh crore rupees. So it's no longer small in terms of size by any stretch. And Prudent's real differentiator is the equity exposure. While the business model itself is not unique, you have another couple of competitors in that space, but Prudent has within its equity basket 97% of its AUM equity, of its mutual fund AUM is actually equity, and that's really the differentiator, that it has such a large and sticky equity AUM within the larger mutual fund AUM that it runs. And mind you, in terms of products, and it'll come straight on your screen, it does mutual fund distribution, which is around 85% of commission income. So when you have such a large composition of mutual fund distribution, and within that as well as fee income, and within that as well you have such a large composition of it being equity, means that the stickiness is obviously higher. But along with it comes performance, and when equity performance lags for a prolonged period of time, you risk that part of the income stream. And we'll try and understand what behavior is Mr. Sanjay Shah seeing on ground. He's the managing director at Prudent, who will join us in just a couple of minutes. Due to this sideways movement in equity markets, how is it playing out on the ultimate investor? So it's not just a B2B, it's a B2B2C business. When you're looking at the other pieces, you've got insurance distribution as the obvious piece. That's approximately 10% of the commission income. Then you've got other products, PMS, AIF, bonds, NPS, fixed deposits, that's 3%. And then you've got stock broking, which is very small, very low single digit. Then there are smaller businesses as well, real estate broking, peer-to-peer lending. So it does all of those. All of it is done on their technology platforms, which is Funds Bazaar, which is for the mutual fund AUM. Then there's Partner Desk, Edge Plus, Stock Plus, which all is within that platform. When you're looking at how Prudent operates, let's start with that. Let's try and understand exactly what it does. First, Prudent signs up with mutual fund houses and AMCs, which actually manufacture mutual funds or actually run these mutual funds. Thereafter, it signs up local advisors, which is generally your registered mutual fund advisors, because they're the only ones allowed to do this. So Prudent has around 38,225 mutual fund distributors, which is what I just spoke about. Now, mutual fund distributors use Prudent's app, platform, technology to ensure that they are able to provide seamless support as well as services to their customers, which is the end customer. Now, what mutual fund distributors bring is retail investors from their own client base as well. But the investor typically, or the mutual fund distributor, picks the scheme, and all those schemes are present on the Prudent platform because they have tie-ups with nearly all the major AMCs. And therefore, it becomes easier for the mutual fund distributor to do the ground level work, which is understanding what kind of returns that his customers are making, how each of the schemes are performing, and also try and actively track whether some schemes are outperforming versus others. When you're looking at what the next step is, essentially Prudent keeps a cut. How do they do their business? They make 88 bips in terms of commission income from the AMCs. The AMCs actually pay Prudent first. Thereafter, Prudent, which is the gross fee that they make or the gross yield that they make, which is 88 basis points of the total. So say, example, they're running 100 crore AUM. 88 lakhs is actually income for Prudent. Thereafter, 57 lakhs is passed on, roughly 57 to 60 lakhs is passed on to the mutual fund distributors who are doing the work on ground. And the thin spread that is left of it is what Prudent keeps. And that's how they get repeat fee revenue as long as the AUM sticks with them. So therefore, the stickiness of the revenue, that's the stickiness of the AUM, that's the one key metric to track. The second key metric to track is whether the mutual fund distributors are increasing in number, because if that is happening, then you will likely continue to see growth. When you're looking at a Prudent, why would a mutual fund distributor go to Prudent and do it via Prudent and not via the AMC itself? There's just one empanelment required, very unlike different AMCs where a mutual fund distributor will have to empanel himself multiple times. Here it's only one. Prudent is empaneled with all AMCs, and therefore it just saves paperwork in a big fashion. Then there's tech access. I spoke about the platform they have, the intelligence that they provide, the returns, and all of the other ancillaries. They follow up because it's a platform-based kind of a business. You get all of that stack on one platform, and which is why the mutual fund distributors also win when they register themselves on Prudent. That's how it's essentially structured. Let's talk about the P&L, and of course then there's insurance and the like, right? That's just cross-sell. Let's talk about the performance, the financial performance, and you'll see the kind of growth that Prudent has showcased, 30% CAGR on a 3-year basis, no doubt about it. This is a thumbs up, by the way. When you're looking at the EBITDA as well, it's grown at 23% CAGR, and the profitability has grown at 24% CAGR. So you've seen some very nice growth coming in all throughout the last 3 years in terms of the CAGR growth. When you're looking at Q1 FY27 performance, revenue has grown 18%. EBITDA has shot up because of there are some one-offs sitting there, and profitability also is higher because of the one-offs, and that's why you've seen that impact the numbers in a positive fashion, of course. But we'll try and get a perspective on a normalized basis as to how this journey is playing out. Let's talk about the margin trajectory, and it'll come for you on your screen. There you go. It does anything between 24 to 29. Typically, it does 24 to 26, and then there is 1 year in the middle, FY23, where they've done a higher margin number. Let's look at the balance sheet, and the balance sheet currently has around 880 crore of book value. It's a 14,000 crore market cap, so it trades at, nearly 15 times in terms of the price to book. In fact, 15 times plus, near 20 times. When you're looking at the borrowing is really minuscule, so no concerns at all on the balance sheet, and there's cash of around 100 crore, which they deploy with regard to getting in bolt-on acquisitions, which is to ensure that if there is a mutual fund distributor with a very large AUM, they just buy him out. That's just one way in which they ensure that the size of the pie keeps growing. Of course, at the right price, that may be important, but that's how they deploy cash. Let's talk about return ratios, and it's a very high ROCE business, because once the platform is built, it's all about recurring revenue coming in, and that's exactly what is playing out on the ROCE numbers. Of course, at one point used to do 50% plus, currently doing 37%, but focusing on higher growth, essentially. And also, once the acquisition happens, it takes some time to kind of optimize, right, on the balance sheet as well. So that too, to some extent, impacting FY26. Let's talk about shareholding. 55% held by the promoter group, so no concerns there. 14% held by FIIs. They've come off versus the FY25 holding that they had. DIs hold around 7%-ish, and the public holds the rest. The public holds around 7%-ish, 24% is held by DIIs. In fact, DIs have hiked their shareholding quite aggressively from 16 to 24 in Prudent Corp. Let's talk about valuations. Now, 45 times earnings is what this one trades at. Certainly, it doesn't look cheap by any stretch, because the 2-year average is around 42 times, and the 2-year range is between 28 and 58 times. Now, there's been a GST issue here, which is why you saw a bit of a cool off on the stock price. The GST pass-through, which was supposed to happen, GST is now grossed up on the expense ratio, which is why you saw that cool off on the stock price, because there was a fear that margins will come off. It's not happened in Q1 FY27. We'll try and understand whether it's a one-off or whether they see that sustaining and how they're doing it as well. We'll try and understand the mechanism straight from Sanjay. But neutral with regard to the valuations for the moment. And you look at analyst recommendations, 4 buy calls, 2 holds, no sells, with a negative 4% upside. So neutral on that as well, because a lot of that upside seems to be priced in. But what we'll do is slip into a very short break, come back, speak with Sanjay Shah of Prudent Corporate to try and understand what's playing out and how to look at the business, Sanjay, from the next 2 to 3 years, because you understand equities better than most. So if you can give our viewers a perspective on your own business. On the other side of this break, viewers, stay tuned. Welcome back, and we're joined by Sanjay Shah, who's the Chairman Managing Director at Prudent Corp, joining us this afternoon to give us his take with regard to the business. Sanjay, great having you. Been a while since we spoke.
Thank you, Hers, and I think you analyze the company much better than even probably I would have done that. So thank you for that. Absolutely.
No, thank you so much. Sir, let me first start off with trying to understand this entire GST narrative, which has played out now and played out on your numbers as well. Just if you could explain that in maybe a minute or less for the benefit of our viewers as to what's happened and whether Q1, the kind of numbers you've clocked and the net yields, if I can call it that, that you've clocked can actually sustain through the year or not. Is this steady state?
So first of all, I think the entire industry was, as far as GST is concerned, was, I think, going through that pretty difficult phase, because if you look at previously, the entire structure was inclusive of GST. So there are 2 sets of distributors. One set of distributors were falling within the ambit of GST, and another people were not falling within the ambit of GST. Both used to get the same rate from AMC. And if you do not have the GST liability, that used to be income. So what I think SEBI has suggested that from 1st of April, whatever is your rate, I think they'll reduce the rate by GST components. Let's say, for example, if you own a rupee, it'll come down by 15.25% because 18 divided by 118 was the inclusiveness. And if you are falling in the GST, you need to raise the invoice for that. Then only you will get, because at the end of the day, GST was the levy component which should go to the treasury of government, not pure revenue. And I think that anomaly has been changed by the regulator, which has been changed by the AMC. And previously, we used to share the revenue, because my partner, if they were not falling in GST, I used to pay them the GST component. But because of this change, we also implemented the same change in our system. And that's the reason, if you look at in the month of July, my 62% revenue goes to GST partner and roughly 30% revenue goes to non-GST partner. And on those non-GST partner, roughly about 15% has been saved by me from 1st of April. This is a structural change. So I think, answering to your question, whatever is the improvement in my yield, that would probably be permanent in nature, because this is a rationalization of anomaly because of the tax structure, and that anomaly has been removed by the government. So we are the beneficiary of that.
Yeah, and your stock has rallied 36% as a result. Was the market missing exactly this, at least at that point in time?
Yeah, sir, because I think that change was previously, because that's the moment this change came in, people were not knowing how the entire the P&L will work out. But once our April, May, June result has been announced, I think my belief is that all the analysts would have factored in this, and the stock re-rating has happened then after.
Yeah, makes sense. If I were to switch focus to your growth levers, right? One of your key growth levers is the distribution reach increasing, or your number of distributors increasing. How is that likely to play out? Now your base has also become higher from when you listed. At what clip can you continue to grow? If you can give us that guidance first off.
So Hers, if you look at previously, the smaller distributor had a strong advantage of getting at least 15-16% extra from the AMC, and they were not ready to work with the platform. But now from 1st of April, those who are not part of platform, overnight that revenue has gone down by about 15 to 20% because there are two changes came. One was GST structure was rationalized, and the auxiliary of 5 basis point has been removed by the regulator. So that has also been transferred by all the AMC to the distributor. So by and large, if you look at the small distributor, their revenue has slipped by about 20%. And now, if you look at the last, there are 2-3 things is happening in last 2-3 years. If you look at the product basket is also becoming very, very strong. So we never used to have the category called SIF. I think now the gift city is emerging as a core product. On the PMS AI, people are asking about. Number of AMCs are also increasing. Compliance burden is also increasing. I think the tech is also evolving very fast. So if you put all thing put together, single person business survival becoming very, very difficult. So if you look at, frankly, last year, month on month, we used to add 400 mutual fund distributors as our business associates. That number has moved to 600 from 1st of April. And my belief is that the consolidation is going to be a very strong buzzword for next couple of years. And I can tell you, to capitalize on this huge drive on consolidation, we added 30 new branches to almost smaller locations, because we believe that smaller locations, smaller guy can easily be convinced to be a part of platform.
No, so yeah, point taken. But does this how is competitive intensity in a landscape like this? So if your the number of distributors you're adding has gone up by 50% starting April, are you gaining market share? Are you losing market share? What's happening?
No, so I think probably the number of distributor added into the industry has not gone up significantly. So when my number has moved from 400 to 600, definitely have captured more people joining my platform rather than new guys joining my platform. So overall, I think it's a consolidation which is playing out in the industry.
Okay. And with regard to equity markets, they've been flat over the last 2 years, right? It's been a very tough market to navigate, and not all mutual funds seem to be providing very healthy returns, right? Trying to get a sense how the equity AUM for you is evolving and whether the fresh flows at all are seeing an impact.
So, Hers, I think we believe that whatever is happening in the entire wealth management, and more specifically in the mutual fund where the retail is investing through SIP, I think it is a structural change, which is to a large extent is not getting impacted because of your market volatility. One important number I just wanted to tell you, that if you look at somebody who has started SIP in September 2024 in Nifty, still as of now, Nifty is down by about 4-5% from the peak. If somebody would have done the SIP, I think the return in 2 years is positive about 4.5-5%. So the point is, the guy who has invested through SIP is at least making the return equivalent to your, let's say, the bank account, roughly about 5-5.5%. So my belief is this is a structural story. There are no significant drawdown which has happened in last couple of years. So the retail has not budged. Number two is, overall, if you look at, I think the my book, if you look at my SIP book, I think probably we were at 830 crore before, about 18 months before. When I'm talking to you now, my SIP book is almost about 1250 crore, and industry is at 31,000 crore. So my market share in the SIP, which used to about 3.5%, has now moved close to almost about 3.9%. So we are probably trying to capture the market share regularly. Yes, you are asking about that from where the growth come as far as me is concerned. So if you look at my SIP book of 1250 crore, if you analyze that, I think we get roughly about 15,000 crore by way of SIP alone on the aim of 1,45,000 crore. So we have a very strong predictable input value of about 10% by way of net addition to the current AUM. If you look at the opening AUM, that number goes to almost about 12-13%, plus the mark to market gain. So if you look at probably last 2 years, so if you look at 23, 24, 25, 25, 26, the mark to market gain was hardly about 9-10% of 2 years combined. Against that, in the current year, already I got 16% uptick in the AUM because of mark to market gain. So normally we always say that please keep in mind 10-12% will come by way of net sales, which we have demonstrated in the last couple of years, and 10-12% should come by way of mark to market. Mark to market may not be linear in fashion. So if you have 1 or 2 years which are not great, probably that would be compensated by the market in that after year, and that has happened in the current year. So overall, we give a guidance that please keep in mind, India has hardly about 6.2 crore people who has invested, only 4% of 145 crore. So there is a huge financial story which is going to unfold over a period of time, and definitely this story has to remain strong.
And then on top of it, you have the SIFs opportunity as well, right? You spoke about that briefly. What's the goal, at least near term, with regard to SIFs? How quickly does your book grow?
So if you look at, I think actually, if you look at last year, we used to add roughly about 35 crore SIP a month. And the SIP stoppage was roughly about 18 crore kind of a number. So we used to add 17 crore kind of number every month. Actually, this number my gross has moved from 35 or 38 crore to 44 crore. But now stoppage number has moved to 25 crore. So now we add about 15 crore. I'm probably seeing at the industry level also and my level also, I think some consolidation is going on as far as SIP book growth is concerned. But probably this is a very good consolidation phase. Internally, we are targeting that we should reach to a SIP book of about 1500 to 1600 crore by end of this year, and by next year we should definitely cross more than 2000 crore.
Wow, that's super strong in terms of guidance, Sanjay. I'm going to slip into a very short break, Sanjay. I need to take that commercial. Need to come back and speak with you a little bit more with regard to the cost side of things and whether margins can hold up, how acquisitions are being looked at, some of those areas. Very clear with regard to at least how the top line is shaping up. Thank you so much for that. We'll slip into the break, come back, talk a little bit more. Stay with us. Welcome back, and we are in conversation with Sanjay Shah of Prudent Corporate. Sanjay, thanks for being with us. Very, very patient. Sanjay, just want to get a sense, how is attrition playing out, and whether at all you're seeing that among mutual fund distributors?
So actually, her attrition is very difficult for us to gauge their number. What is important for us is to just look at what are the activation ratio of partners in my system, because it's an open architecture. Somebody who has become a partner with Prudent and he has enrolled with me, he can very well go and work with the AMC directly, or he can be a part of other platform also. So it will be very difficult to say, because there's nothing like somebody would discontinue working with me. Let's say you have started 5 SIPs with Prudent, you will continue to service those clients and will continue to give you the revenue sharing also. So if you look at my number of partners who give me a single transaction in a month, that number is improving very fast. So let's say the active partner ratio per month has to be in the range of 40-45%, and we are maintaining that number. So that is very, very steady.
Understood. Sanjay, one more piece is how costs are going up for you, and your employee costs continue to inch at, or rather increase by nearly 24-25%. When does OPEX efficiency and leverage start to play out? I know there's some part of it is already playing out, but meaningfully and significantly.
So hers, basically, because if you look at this entire industry is driven by the manpower and the physical reach and the digital platform which you create. And as I told you at the beginning, we have sensed that there is a strong opportunity for us to expand our present branch network, and we are going to add, or we already added 30 out of 30, almost 25 is completed. So we added 30 branches. And when I gave the guidance for the cost, I think 15% was the inflation on the existing team of last year, and roughly about 8-9% is the expectation that we'll have the new manpower which will be added. So I don't think 8-9% growth in the new manpower will be a regular feature, but at least as far as my employee cost inflation is concerned, I think it will remain in the range of 12-15%, because the availability of quality manpower is always an issue in this industry.
No, sure. What's the acquisition strategy, and does it remain the same as has been the case? You'll keep doing bolt-on acquisitions. Are you doing something different, new, given AI and all of the tech changes that are happening?
So fortunately, hers, we have a very strong IT team, which is a part of organization, and they are capable enough to work on the AI. We definitely take the help of outsiders who work as a consultant. However, I think my CTO and entire team is very, very strong. So as you told in the beginning, we also launch we are probably very ahead of the curve when we talk about launching the Age Plus and the Age, which is the entire AI platform for my partners and for my mutual fund, for my client on the fund bazaar. Now, coming to your questions regarding sorry, what was the second question?
How are you looking at acquisitions, quantum, amount, and integration of the Indus acquisition as well? If you can give us some color.
So fortunately, Indus integration has been very, very successful. And as you knew, when we acquired Indus last year in September, their AUM was about 2030 crore and their SIP book was roughly about close to 10 crore. When I'm talking to now, their AUM has reached to 2,450 crore and SIP book is upward of about 11 and a half, 12 crore. So I think it's a very, very fruitful, successful acquisition for us. We have been regularly scouting for acquisition because you understand it's a very asset-light business. And as you explained that my ROCE is going down mainly because the money which you earn is now getting deployed only into treasury. So if you look at operating profit and the operating business is doing very, very great, whatever we earn is parked into our mutual funds, mainly into our treasury. And we are preserving this capital for the acquisition purpose, regularly looking at the opportunity. There has been always a regular consultation with the people, but I think whenever we'll able to close something, I think we'll come and tell in the public.
Okay. All right. Thank you so much, Sanjay, for coming in and speaking to us. This gives a much better picture on how the company is going. Thank you.
Thank you very much.
All right. And viewers, all the time we have on this edition of All About Your Company, I want to take this opportunity to especially thank Shawnee Chaudhary, who's our producer on this show. It's her last day today, and we thank her for everything that she's done. And especially thank you for bearing with me, Shao. With that, it's a goodbye on this show. Thank you so much for tuning in.